fish and chips, warm beer, pickled eggs, spotted dick, with custard, and short-term fixed rates. No, we're not talking about the menu at the Reform UK Party Conference. We are talking about some of the oddities about this funny little island we call home. The UK is almost unique in the world in terms of our mortgages. We have lots of 2-year fixes, lots of 5-year fixes. In fact, very little longer-term fixes. And yet elsewhere, it's the other way around, isn't it? In most countries, 7-year, 10-year, 15, 25-year fixed rate mortgages is very much the norm.
Yes, I mean, most of Europe, you're matching the mortgage term with the fixed rate. So, 25 years, 25 years.
Yeah.
So, you're not sort of looking to refinance every 2 or 5 years.
So you buy a mortgage once, you fix the term at 20, 25 years, your interest rate stays the same for the whole time.
Yeah, I mean, you review it at various points, but yes, you're not looking every 2 or 5 years to kind of, review the interest rate, basically.
So why is it that it's so different here? Is it we're just crazy and we like to have this sort of short-term fluid mortgage market? Why is it there's so little appetite for those longer rates here?
It's historical reasons, basically. It's kind of the way it's been, and it's just kind of stuck like that.
Okay. Now, you've done some interesting digging in terms of which products people are buying. Now, we've got to be honest, 10 years plus rates do exist here in the UK. They've always been a niche product.
Yes.
Demand is getting even tighter there, isn't it?
Yeah, if you look at the UK finance numbers, 2023, longer than 5 years was around about 3% of the market. It's less than 1% now. It really has died a death. And accepting that we're kind of at or near the bottom of the interest rate curve, you kind of expect, in theory at least, people to be starting to look at, locking in for sort of 5+, and it's not happening.
Why not? Demand is not there, is it?
Demand's not there, and really the swap rates are not helping. If you look at kind of the 10-year swap rates, the sort of 15, 30-year swap rates, they are 30 to 50 basis points up and over where the 5-year is, simply because the sort of demand or the pricing that investors are demanding for the longer-term gilt rates is that much higher.
So that means that the product rates on those longer-term fixes are just going to be way higher than a 2-year or a 5-year. That presumably is putting borrowers off.
Yes, so it's going into the swap curve. So the swap curve for sort of 30-year is 30, 40, 50 basis points high, historically high. I think you had the number on where we were on the 30-year.
Yes, so we're into gilts now, which of course is what drives those swap numbers. And so the 30-year term gilt is at its highest level in 27 years.
Yes.
And of course, this is to do with government borrowing costs. It's painful for the government, but it's very painful for lenders who want to offer those very long-term fixes.
Yeah, this isn't just a problem unique to the UK. It's going on across the world. So Japan, Germany, America, every country is experiencing the same thing. No one particularly wants to hold longer-term government debt at the moment. Lots of countries have got problems in their economy structurally, kind of looking at further out more than sort of 5 years about how they fund their economies and kind of, who wants to be holding longer-term government debt. There's another sort of particular UK issue at the moment. We obviously had quantitative easing going back through COVID and way beyond that as well. The government has got going on with quantitative tightening at the moment. So the Bank of England had a lot of government bonds. At the moment, it's selling them back into the market around about 100 billion a year. It's difficult to be precise about what effect that's happening, but it's round about another 10 to 20 basis points is going on the cost of longer-term debt as it sells these bonds back into the market. Now, that's a shorter-term issue, we think, for the next couple of years, where there's obviously more supply going back into the market, but that's causing sort of the 10-plus gilts to sort of rise by that amount, and that's getting reflected in the swap curve as well.
Yeah, it's an interesting one, isn't it? So we've got all this supply of these long-term bonds, these gilts going onto the market. That's driving up the yield.
Yep.
Which is driving up those swap rates.
And it's making the longer-term fixed rates much more unattractive.
So is this kind of game over for those long-term fixes in the UK?
It's not game over. It's making it more challenging at the moment. I mean, we think or hope there's probably, or there should be, a balanced market that the consumer has a choice between, fixing short for 2 years, fixing all the way out to 25. And we're hoping that, this issue that, investors don't want to hold longer term government debt kind of reaches an equilibrium in, the next couple of years, that it kind of balances itself off. The quantitative tightening is a short-term issue where the Bank of England just kind of, removes these bonds from its balance sheet over the next sort of couple of years. So it's a problem now. Hopefully it won't be a problem in sort of 18 months, out from where we are now.
Okay, interesting points there. So we've covered a lot there. We talked about gilts and how they affect the swap curve and those long-term fixed interest rates. But don't write off the 10-year, 15-year plus mortgages. They do exist. Demand for them is not there because they're so expensive. But, Peter, an optimistic note to end on.
Never say never.
Yeah. Thank you for joining us on the Rate Stuff Extra. This is your bit in the middle between the main episodes that we do, where we choose one big topic. We're always looking for things to cover. This week was all about those long-term fixed rates. But if you've got an idea or a question you want us to tackle, you know how to get in touch. Hit us up on the socials. Give us a like or a follow. That helps people find us out there on the internet. But for now, thank you very much. I've been Jack Izzard.
And I'm Peter Stimson.
Join us next time for the Rate Stuff.